everyone, welcome back to Focus Investing, where we follow one course until successful. And on today's episode, I'll actually like to talk about a company that recently reported their earnings, and that is Dropbox. This is a company that I'm genuinely interested in as it has a lot of potential for growth in the next several years. But before we begin, make sure to have been subscribed to the channel if you haven't already. And if you enjoy our videos, you can go back to the previously downloaded videos. For example, I did one episode on Twitter where, I pointed out the stock at, I believe it was around $40 per share. And now it's anywhere between $68 to $70 per share. So please be sure to, leave a comment below and stay engaged and let me know what you think about my analysis. But on this specific episode, I'll be talking about their earnings, right, and what that means for the company and for the stock going forward. Let's dive right in. So here we're looking at the 180-day moving chart. It's the 4-hour chart, and I'm using the TD Ameritrade Thinkorswim platform. As you can see right here, the stock is near a support on that single day moving average, and as you can see right here, the stock did hit a high of $25.80 recently, and has since been selling off, especially in light of their recent earnings, although their earnings are not as negative as investors seem to be taking it. But hopefully the stock does hold right here at this single day moving average, and if we can get a bounce back from here, then I think we're probably headed for about $30 per share. But before we get there, let's look at their earnings and what that actually means. So currently the stock is actually, their market cap is $10.1 billion as of today, with a trailing PE of 129 and a forward PE of 24, which is not bad. Their profit margin stands at 4.5% almost. Their revenue is, I think they just hit that $2 billion mark, which is incredible. Their quarterly revenue growth is almost 14%, give or take. Their adjusted EBITDA is $225 million. Their total cash currently is $1.2 billion. Their total debt is $131 million. And their operating cash flow right now is $586 million, or 587. And let's dive right into their recent earnings, right? So fourth quarter revenue, $504 million. They're up 13% year over year. Net cash provided by operating activities, that's $170 million. Free cash flow is $158 million. And like I had indicated earlier, they did surpass that $2 billion total annual recurring revenue, right? So fiscal 2020 revenue is $1.914 billion, as in 15% year over year, which is incredible, and they continue to grow. Net cash provided by operating activities is $570 million, and free cash flow for that year is $490 million. So this is something that I like to pay attention to, which is on the annual recurring revenue, right? And that ended at $2.2 billion. That means, they have a recurring revenue stream of $2 billion, which is incredible. I mean, a business that has a recurring revenue means their only way to lose that is by, I guess, customers leaving the business, or they're not using their products or services. But essentially what that means is, this company is positioned for continued growth, as long as, their sales numbers stay up. And like I said, at $24 per share, or 23 today, I mean, this stock is, you just can't have it any other way. I mean, this is a stock that everybody should consider buying, especially if you're looking at 2 to 3 year term. This is a stock that could double, essentially, from 23 to, let's say, I don't know, $40, $45. That's almost double. So I think this is a stock that is positioned for continued growth, continued success. And I know Wall Street tends to be a bit skeptical about this stock, especially 15% is not so crazy when you have companies like Facebook growing at 30% revenue year over year. But you can't have every company growing at 30%. Some companies are just going to give you that 15%, anywhere between 12 to 15%. But as long as that is a steady stream and it continues in that trajectory, I would rather invest in a company that has that kind of, I guess, gradual but a steady growth. Um, and not, a one-off 40% year over year, and then next year you have 30%, and the following year you have 20%. It's like, I mean, that's great. All are great, but when you have a steady growth, that means you can capitalize on your previous year and growth to propel you into the future and keep planning and growing in a more sustainable fashion. Uh, yeah, that's all I got for Dropbox. Please be sure to subscribe and let me know what you think about this stock. Thanks for tuning in.